Okay, Q&A time from the last market outlook. And again, I'm in Costa Rica. Forgot my microphone back in Canada, so I am using the laptop microphone. Hopefully the sound is okay. What's your take on FCX and HG after Tuesday's rally? That was based on the announcement of stimulus out of China. I don't know how effective that's going to be, but this is the initial reaction. I got stuck with negative delta on FCX, 600 shares, September 27th, 45 call. Woof. And September 27th, 45.50 call. Would appreciate any advice how to unwind it. I don't know. Well, you can try rolling the calls forward further dated. I just don't know how much follow through there's going to be. There could be more upside. Personally, I think it was a little bit celebratory today. My personal opinion is these gains probably won't hold. But, in the short run, all sorts of things can happen, right? So you have to do what's right for you. I don't know that I would have been short copper in any degree at all. I would have been long on weakness, but I don't know that I would have shorted. Covered calls, I think, are fine if you're trying to lower exposure or generate extra income, but naked short on copper, I wouldn't have done it. You say you expect TLT to go back to 160s over time, yeah. So you expect a 30-year treasury yield to fall significantly from current levels? I do. What about all this talk about fiscal deficit expanding further and thus much more supply of bonds coming in? There will be. Don't you believe that could push yields higher instead of lower? Not really, no. Have a look at Japan and look at the sheer amount of debt it has versus its GDP. And bond yields are super low because they really have no choice but to go back to the zero line. To afford the debt, the Fed is going to have to, if we think about yields, well, there's money market, there's capital market. Fed is going to have to bring rates down, and it cannot allow this kind of curve to go on. It will engage in quantitative easing to lower that curve. All for the affordability of the debt, because if you don't make the debt affordable, you make the budget deficit unaffordable, which means you make taxes more affordable, which means you squash the economy. And you would have to even begin to service the amount of debt to where it's going. So either you force the U.S. government into austerity, which would crush the economy, or you feed their appetite, which means the Fed becomes the biggest buyer of bonds. I don't see fiscal responsibility coming anytime soon, which means the central bank will have to do all the heavy lifting on this one. Until something changes on the fiscal front, I don't see this changing. Would love to hear your opinion about the Meldrum's latest YouTube. I saw that one about the central banks. I did talk about it in the live feed. I think he is, sort of missing his lessons on valuation. When you value a company at this point in time, you don't look backwards, you look forwards, and then you discount and you come up with a valuation on the company. And from that valuation, you'll say, well, this is a buy. And then as the company goes on, its fundamentals improve in the direction that your valuation implied. That does not mean the valuation caused the improving fundamentals. The fundamentals followed the valuation. The market is a forward-looking mechanism. It will discount known information, including into the yield curve, and yields and rates will change in anticipation of the fundamentals changing. The fundamental in this case being the Fed. It's the same thing. I don't know why he felt the need to say the Fed follows. It's the same thing as saying the fundamentals follow valuation. But that's not really true. The fundamentals are what they are. It's just individuals, investors look forward and project out what they think is going to happen. Now, that doesn't mean that the market is always right. Sometimes it's right, sometimes it's wrong. He basically goes against a lot of things we learn in CFA. No, he doesn't. He just he just thinks there's a different lesson in the market discounting the future when it comes to the Fed versus the market discounting the future when it comes to valuation, and there isn't. How often are prior year quarter earnings revised for public companies? It's usually quite rare. It's quite rare that they are revised. Just wondering if you should take time to review each line item prior to reporting periods to make sure they align with what you have from the initial report. If there are restatements of past numbers, it would be announced that the company is restating so many years of earnings. It's very rare that it does. Sometimes there's a change in accounting policy, and they will tell you that it is being adopted prospectively, which means only from this point forward. Sometimes a change in accounting policy, when they have a 10K, they have 3 years of income statements, and the change happened in this year. They might restate the prior years in accordance with the new accounting policy. Yeah, that's just part of the world you have to deal with when you're an analyst, is you have to unwind all of that to see, well, do you go back and do you account for those changes in your historical look-back period? Sometimes it's not important. Other times it may be significant. But accounting standards that are restated retrospectively are, you don't have those happening every single year. So they're few and far between. Given your position on U.S. CAD, are you investing in the IC listings of new positions opening in Canada? Nope. No. I want the options, and for the Canadian stocks that I would pick, the options are much more liquid on the Montreal Exchange than in Chicago. Even though the Montreal Exchange really isn't that liquid overall, they are far more liquid on the Montreal Exchange. Feel like Meldrum's argument on the Fed was that it's a follower of the macro environment and not markets. Well, yeah, I mean, the Fed isn't that forward-looking. It's not in the business of projecting out what the economy will do. It's in the business of responding to what the economy is doing now. So it does look at the data, the incoming data. You can say quite fairly that the Fed, is guiding the economy by looking through the rearview mirror. I mean, that's a fair statement, a fair enough statement to say. If you're going to relate it to the economy. But the market can see the same things the Fed is looking at. So the market anticipates. And sometimes the market anticipates correctly, and sometimes the market gets it wrong. If we think that the Fed is the baseline that they're trying to predict. We can also argue that the Fed gets it wrong, but sometimes the Fed gets it right. It is a brutal game when you begin to predict and try to predict the future. It is a brutal game because you are predicting something that is not complicated but complex. And being that it's complex, it is unknowable. It's not that you don't know enough to know the future. The future is unknowable, right? So it is, you do the best you can, but the further out you go, the more likely you are, on average, to be wrong. Curious about your recent positions on ZQ and TLT. They seem to contradict each other. No, they don't. One is the short end of the curve, one is the long end of the curve. ZQ is the path of the short rate. So it is the Fed funds rate, not even the short rate, it's the Fed funds rate over time. And if we think about money market curves and capital market curves, if the Fed is at 5%, let's say, all the money market rates will hold close to 5%, then the yield curve does what it wants. So you can go ahead and let's say that you had a curve like this, you can go ahead and lower rates, and the long end of the curve might do this, so that longer yields may actually go up and not down. So they don't contradict each other. One is the short end of the curve, that's ZQ, and one is the long end of the curve, that's TLT. TLT is a 20-year plus ETF. The average weighted maturity is 25.5 years in TLT. Very, very far away from the overnight rate. You mentioned not using financial modeling for stock valuation. That's true, due to many assumptions involved. In that case, how do you determine if a stock is undervalued? I don't really think about whether a stock is undervalued. I look for deep value. I find that there's so much opportunity there. I look for out-of-favor stocks, out-of-favor sectors that have a really good story. And for valuation, you can look at a whole bunch of things: price to book, price to earnings, price to free cash flow, enterprise value to EBITDA. There's lots of multiples that you can look at for valuation. You don't have to engage in a full 5-year forecast, terminal value, discounted cash flow. You don't have to engage in that to come up with what you think a price target is. If there's a good story involved. And I think that for some stocks, there are good stories. Months ago, I was talking about Canadian apartment REITs and Cap REIT in particular at a significant discount to its net asset value. Their capital recycling program was meant to avoid rent-controlled apartments, which was a good idea to do. It was a good story, and its fundamentals were good, its growth was good, and being at $43, I thought, was absolutely wrong. Well, it's 55 to 56. What is that, three months later? You got about a 25-30% return in an apartment REIT. That's what I look for. I look for those things. They're few and far between. You're not going to come up with 5, 10, 15 ideas every single week. You come up with a couple, one or two that make it onto your list every week, and maybe out of a course of a month, 1 or 2 of the 5 or 10 you look at are worth buying. But they usually work out quite well. I look for stocks that I want to see that management is well aware of the challenges and the problems. If it has a lot of debt, I want to know that management is well aware that it has a lot of debt and is concerned about it. That was AT&T when it was $15, $16. What is it now, 22? Over a 6-month period for a big network company like AT&T to move, what is that, almost 40%, all within the same year. That's a big move, but deep value has incredible returns. You don't need to look for high beta, high growth stocks to get that. In general, is it better to buy gold mining companies or gold instead? What gold ETF there is good COMPEX? The gold ETF is GLD for holding gold. For gold miners, there's my brain withholding something that I know just to publicly embarrass me. And once I don't need that information, my brain will release it. You will get to that age too, where your brain just decides to hold words hostage. Just Google it. If you Google gold miners ETF, you'll find it. There's a couple of them out there. Take the biggest one, the one with the most assets under management. It'll have the most liquid options. And there's also GC, which is the gold futures contract. It is for 100 ounces. There's also a mini gold, which is for 10 ounces. And you can play that one. That one's fairly easy. These don't do anything. What you get out of these, I think the easiest way to play a futures, because the futures have a carry in there. If you are playing futures, it'll be in contango. The spot is below, so buying it, even if the spot moves up, you'll underperform always. that I would look for, a certain distance out, 60 days, let's say it. I'd look at whatever, and the futures contracts look like this, right? They're not upward sloping. They look like this. Selling the put above this, I think might make sense, or selling, this way here. You can get the same performance, at least as long as gold doesn't go above that price. The miners are good because they pay dividends, right? So you get paid to wait, plus you have a nice series of options. So you can always buy Newmont, and you're going to get a dividend while you're holding Newmont, and you can go down to the 15 Delta puts, and you can sell puts down here that if it fell down, dropped, you'd get even more shares. I would not sell calls because Newmont has both gold and copper. Their secondary is copper. They mine gold, but you don't just get to pick and choose what the ore gives you. You pull ore up to get gold out, you're going to get copper, or at least where they are, they're going to get copper with it. So they get a lot of copper with the gold, and both of these are up. Can you please add the Eurozone to the economic data? The Eurozone, we think about it as one place, but it really isn't. It's a couple of significant countries, Germany being the big one in there. I just don't know enough about the Eurozone, and I don't really play the Eurozone at all, and I don't know how the Eurozone fits into everything, and you're complicating it with a war in the middle of it all. So other than being able to repeat the economic data, I can't really tie it into anything, so I don't know that I would do that. Would you sell Theta with an expiration right before earnings? No, because the implied volatility is going to be very high, and it's not really Theta that you're getting out of there. It's Vega, and after earnings, either you'll make money or you'll lose money. It's a binary outcome, and I really try to avoid binary outcomes. Thinking no because of the increased volatility before those days. Yep. How would you avoid selling Theta on underlyings that share the same risk factor? Duration such as banks, TLT, utilities, REITs. Well, yeah, a lot of them have a duration exposure. And so you got to think about, I don't know that I can get enough duration exposure right now. I've done even more on TLT this week to gain even more positive exposure to TLT. I really went aggressive on Canadian banks as well. Utilities, I'm looking for a nice utility right now that is, like NextEra, that is, not fully regulated, but partially regulated. It takes time to find the right things, but I don't know that I can get enough duration exposure because rates in the US are 5% and coming down. My absolute best winner is going to be duration over the next 12 months. I don't know how beta pays. Beta looks like it wants to keep going, but I know duration pays because it's mathematical. I know duration pays. So, I like things where the probability of winning is extremely high. Then I can take oversized positions and bring leverage. And there are so many great ways to get duration right now that's really what I'm looking for. And some of these duration plays are also significant other plays. Utilities are a big AI play as well. They take so much energy for these data centers and these big supercomputers. They take so much energy. Look at what Microsoft is doing, having a 3 Mile Island nuclear facility restarted just to power its data center. It requires so much energy. That is why I'm trying to find the partially regulated utilities, because they do have, they can build assets that do not benefit the rate-paying community. And if they can build those assets for a particular client, they're not regulated on those assets. That's beautiful. So Right now, NextEra seems to be about the big one there. But you know, some of these things have beautiful other stories. Utilities have its own story, and if you believe in utilities and AI, you gotta believe in copper, right? REITs is a play on the slowness of housing to catch up with the size of the population. Apartment REITs especially. And housing is one of those things that, well, that works if how home builders can keep their margins, but REITs will always perform. And since their cash flows are very bond-like, they will play like duration. I can't get enough duration right now, I think. Video on how to manage margin and margin interest for different assets in the applied level. I really, the higher interest rates are, and by interest rates we mean, you know, like the 3-month, most, or even the 1-month rate, whatever money market rates are, the higher money market rates are, the less you should be using margin loans. You should not even be using margin at this point in time at all. So that would be a very short video. When the overnight rate is 0% or 0.2%, and all money market rates are very low, all SOFR rates will be very low. Margin is super cheap. Rather than using a margin loan, use securities with embedded leverage. You should never be borrowing from your broker. You can always use securities with embedded leverage, like options or futures. If you want to bet on the market, rather than using twice the amount of capital you have and having a margin loan, think of using ES, think of using a futures contract, right? And then all the other cash you have, because you're long a contract with negative carry, all the cash you have that you're not using to actually buy the stock SPY, you would put in 1-month T-bills, which would have positive carry, which would, well, actually you can go 3-month, because the futures contracts are 3 months at a time. When September rolls off, you fall into December. Now, when that rolls off, you go into March, so you can always roll over your 3-month T-bills. Gives you positive carry, negative carry. You have no carry. You have pure beta with futures. You can always do better with a security with embedded leverage than using margin. Don't pay to borrow money. You know, don't use margin. If you're using margin, you're not doing things right. You think about an individual stock, use a synthetic. If you have low interest rates, what you do is you buy a call and you sell a put at the same strike price. You have a delta equal to 1. That is the same as owning the stock. There are much cheaper ways to mimic margin than using margin loans. How to prepare for CFA? Should I just watch the videos and go to the notes and question banks? Well, how did you prepare for any exam you had in university? Same thing. Did you do exercises? Did you read the book? Did you attend classes? Same thing. It's the same thing. Whatever you did to be successful in your university career is the same thing you do here. The exact same thing. Should we skip reading the book? Were you successful in any of your undergrad courses? The ones you got A's in, did you say, well, I didn't attend class, I didn't read the book, I didn't do exercises, and I got an A? I mean, if you went all the way through university without reading books, doing exercises, going to classes, then give it a shot. But I doubt if your answer to that is going to be yes. So why would the answer here be any different? Once I have seen in live stream you were saying about how the prices have risen up in Costco for goods like olive oil. Cost them $30, $38.99 for 3 liters of extra virgin olive oil. Used to cost $22. Used to cost $23.99. I remember when it was $18.99 just a couple of years ago, and now it's like double that. I want to ask you, since you're financially well, that you shouldn't bother. You can buy anything you want. That's true. I can buy anything I want, but that doesn't mean you ignore the prices. It doesn't mean you just look at stuff and say, well, I'll take it. I went ahead and bought it, but you look at the price and it still sets you back. You still look at it and say, I didn't have to make a decision going, should I put this in my cart? There was no trade-off for me. I put it in my cart because I use it, but I think, how would people who make a paycheck every week doing it? They must be making trade-offs on this, right? I'm my mind is always on the market. So you have to think about, what you're seeing out there and the trade-offs and prices that you're seeing. So I think about it in terms of how's the consumer doing? Yeah, I'm generally immune to the price. I go ahead and put it in the cart. Doesn't mean I enjoy it. Just because you have a certain sense, a certain level of financial success, doesn't mean you no longer care what you pay for things. I mean, you do. You look at them and you think, holy shit, when did this become so expensive? I thought I was wealthy. At $39 for olive oil, I'm not. you know. When can you, or we say you or we, have mastered something? When you realize how little you, how much you don't know, right? That's when you can then begin to say, I understand this. So when you first start learning something, you learn a little bit, you think you know it all. Then you start to realize how much you do not know. And then you start learning more and you realize how big the field is and how little you actually knew. Then you get to a point where you go, okay, I get this. And you recognize that there's a lot of stuff you don't know, but the stuff you know, you really know. It just takes some time. So it's like a U-shaped curve in terms of how it looks. So this is time, and this is call it your level of expertise, not in an objective sense, but how much of an expert you think you are, right? Over time you realize I don't know anything, and over time you actually start to become an expert. Here you spend a little time on a topic, you think you're an expert. This is the TikTok finance guys, been in the market 6 months and they're putting up videos telling you how they've got it all figured out. They've got it all figured out, right? Yeah. Notice that the margin requirement for writing a single put option has increased. Has it? Well, the premium has decreased since the rate cut occurred. Well, premiums would decrease if implied volatility decreased. Is this change due to the rate cuts, or could it be related to something specific to my account? Well, when you're saying the margin requirement, you have to be careful with something, right? So let's say that we have a stock that looks like this, and you were selling puts at this point in time. Let's say implied volatility was 25%, and this price was, let's say, $60. And then we've had this nice rally up, and you're selling puts at $80. Well, that's going to require more margin because it's now $80. Even though let's say this was a 20 delta, and let's say that this was a 20 delta, it's just got a higher strike price, so it will require higher margin. And if implied volatility dropped from 25 to 20%, the premium will be lower and the margin requirement will be higher because it's $80, not 60, and this is 20%, not 25. So, when you say the margin requirements are higher, if you're thinking about TLT, well, TLT's gone 92, 93, 95, 97, 98, 99. If you're writing constant 20 delta puts, your strike price will keep increasing. If you mean for the same strike price, I've not seen that. I have not seen that at all. Based on forward curve, how many rate cuts do you anticipate for Bank of Canada by the end of 2025? Well, I don't need the forward curve for me to anticipate. The forward curve is what the market is anticipating. How many rate cuts? One every meeting. So what do we got? We got 2 more meetings this year from Bank of Canada, 1 at each meeting. 2 more. I thought it would be, at the beginning of the year, I thought 100 for the year. Looks like we're going to get 125 out of BOC. You mentioned a zero line is the only place to go because a digital world is deflationary and an increasing debt world is expensive. Correct. Can you elaborate further on how these two forces will cause rates to go to zero? I think it's pretty self-explanatory, right? The general consensus is rates will stay elevated to maintain and service the high levels of debt. But why would you keep rates high to service the high levels of debt? All that will do is crush the economy because that money has to come from somewhere. It has to come from higher taxes, which will crush the economy. It will keep growth low if you have to keep extracting money out of the economy to pay the interest. Or the debt just keeps getting bigger and bigger and bigger, and at some point it becomes unaffordable, which will crush the economy. The Fed will have to step in. They will have to step in. And when you have deflation, you can't get rates low enough, because central banks more than anything don't want deflation, especially for a country with that much debt. Deflation makes the debt that much more expensive to pay because tax revenues start going down with deflation. You got to avoid that at all costs. I think it's pretty obvious. If you have deflation, rates will go down. If you have that much debt, and if you're worried about full employment and a healthy economy, you have to make the debt super cheap for the government to continue to be part of GDP. To continue to spend, right? If the main goal for the Fed is go to zero. I didn't say the main goal for the Fed was to go to zero. I said it is inevitable, I think, that they go to zero. I don't think anybody in the Federal Reserve System thinks going to zero is their main goal. U.S. to be depreciated. Again, I don't think that's the main goal. These are what I think eventual outcomes. Is it feasible to all in 30-year bond and leverage into? Is it feasible to all in? All in? It's never feasible to go all in on anything. So no. Having exposure to duration? Yes. But all in? No. And leverage into emerging market. Why leverage? Why use leverage in emerging market non-U.S. assets? Because of a weaker U.S. dollar, you think? In which case, commodities. You don't even have to go shopping in emerging market. You don't even have to take on Forex effect. Take on commodities. Copper and gold are both going up. They're both going to continue to go up. Come back in 5 years, copper will be much higher, gold will be much higher. They're denominated in U.S. dollars. The lower the U.S. dollar goes, the higher they go. There's your play right there without even touching a foreign currency, right? What are your thoughts on cybersecurity stocks over the mid to long term? I've not really thought about that sector at all. I don't know enough about the sector to make an opinion on it. With AI rollout and expansion coupled with greater interconnectivity, I believe the subsector will be vital. I think you're right. I think if you're going to have vehicles that are driving themselves and a grid that talks to each other, security is going to be wickedly important in that. There is certainly risk with breaches. And that will never stop. And the criminals are never going to go away. They are part of the distribution of the population, the left tail, and they will always, always, always be with us. So everything we do, everything we pay for has within it the cost of crime. So we do pay. Even though we are not victims of crime, we pay for crime. When you go to a store and you buy clothing, a certain amount of the price of the clothing is for shrinkage. Shrinkage meaning theft, whether internally or shoplifting. It's factored in how much will be stolen, and it's added into the price of the clothing you pay. We pay for the left tail all the time. There are going to be breaches, which means there's got to be security, especially for critical functions like self-driving vehicles. If we see a future of self-driving vehicles, the grid that you need and the security that you need, yeah. Good story for Uber, yeah. It sounds like it's great to go long. I think so. Have you considered going long on it? No, not yet. It's I don't know that it's not a deep value thing. It's nothing that I get really excited about. I think it's a good play. I think it's a good long beta play that probably has a lot of promise in the future, but it's not deep value for me. As someone in the mid-20s, I know XLK is great. Yep, I can't bring myself to invest in it at the moment, given that it's priced to perfection already, priced to absolute perfection, as if everything that is going to be perfect will absolutely happen. I agree. It's like, well, let's say that everything unfolds as we say. It's already in the price. Where's the price going to go? I agree with you on that. That's why I can't bring myself to buy these things either, is that I think Uber in 10 years will be higher than it is today, but that doesn't mean it's going to go from here to there. It might go from here to there first. I don't want to live through that, right? Now, I may be wrong. It may do this to get there. I don't know. Nobody knows. Nobody knows. But if you're in your mid-20s, you can survive this. As long as you have a capital contribution plan where every quarter you're going to put $2,000 in the market every quarter, then you can live through that. Who cares? It goes down, it'll go back up. These things don't just go in one direction. It'll go back up. And if you have if you're young and you have a capital contribution plan, then that's fine. That's fine. I wouldn't recommend it for somebody approaching 60 or within 5 years of retirement. I don't know that going with a big exposure on that is such a wise thing. Would you rotate from XLU to XLK if you're in your 20s? I would stay with utilities, because utilities, I think, is a great AI play. I don't know who the winners in AI will be, but all of them require energy, massive amounts of energy. So if you want to be in the gold mining business, you sell the shovels, right? You don't invest in the gold mines. Like if you think back to the California gold rush, the people who made consistent money all the time were the ones who sold all the supplies to all the panhandlers going up in the mountains. You need copper, you need utilities. Planning to start a portfolio tomorrow of 20/80 XLK XLU, gradually increase up to 80/20. 20 XLK, 80 XLU. 80/20 is rate cuts near its end, but rotating may not be yield as great results as 60/40. I'd stay with 60/40. In your 40, if you want to say 20% of that is TLT, 20% of that is XLU, because XLU is very much like a duration thing. And in your 60, you might want to say, I'm going to go 40% XLK and 20% XLP, which are the staples. In a market downturn, your utilities, your duration, and your staples will do well. In a market rally, your XLK and your utilities will do well, and with rate cuts, utilities will do well. Staples will be the only one where you go, but Staples has a nice dividend yield, right? So I'd go 60 on equity, 40 on duration. There you can get XLU as a proxy for duration, XLT, and here XLK and XLP. So 40, 20, 20, 20. That looks like a nice. That looks like a nice portfolio. In essence, you have 80% in utilities. 80% in equities, 20% in bonds. But let's face it, XLU really is a big duration play and a big AI play. So it has a little bit of crossover with XLK. In a recession, this will do very well. This will do very well. This will do better than this, but this would probably still go down, but outperform this. This would drop. I think in a recession, your portfolio would be pretty good. Pretty good overall. Yeah, that's a nice setup right there. Let's keep going. Would you say it's a good time to get out of home builder stocks? They've had a long, great run. I don't know if it's a good time to get out. My argument with the economy, it's probably a good time to reduce exposure. I don't know about a good time to get out. Maybe we can get another sunset live stream now that you're back in Costa Rica. It rains. It's September. It rains all the way through to like November. There is no sunset. I don't know if you can hear that right now. You hear that in the background? I have a metal roof here, and that's just rain from 3:30 in the afternoon right through till 7, 8, 9 o'clock at night every single day. There is no sunset. There's no sunset. While you can argue the symmetry between hikes and cuts on the S&P 500 companies, it can be argued that cuts will impact the consumer and as a result a positive impact on earnings. Cuts, increases didn't hurt the consumer on the way up. GDP was strong. The C component of GDP kind of remained strong throughout. But on the way down, you have a lot of homeowners with mortgages under 3%. So as rates went up, it didn't hurt them. As rates come down, it's still the same mortgage. I don't know that it'll help them. But at the margin, there will be some incremental benefit, much as on the way up there was some incremental decrement. But I don't think it's the bigger part of things. Considering a switch into teaching at a university. Been in the industry 20 years, like to share my real-world learnings with students. Do you recommend a switch at this point in my career? So teaching is public service, right? Nobody goes into teaching to be rich. It's public service. There's not a lot of money in it. You're doing it for the love of something. The love of teaching, the love of sharing knowledge, of helping young minds. But you're certainly not doing it for selfish reasons. It is selfless in the sense that you are giving up what would otherwise be more money in the real world to be at a university. It is a form of public service. So, it's not do I recommend a switch, it's do you recommend a switch, and why, and the question, why are you switching, right? And once you figure out why you're even contemplating the move, and you understand why it is you're doing something, then fine. 10 years from retirement, a bit concerned AI will take over at bigger universities in the next decade. Universities have a 1,000-year-old business model, and they are so slow to change that it's brutal to watch them. No. AI will not take over at universities for decades, no matter how good it is, simply because universities are brutally slow to change. Brutally slow to change. They still have 4-year university degrees long after the usefulness of 4 years is over. There is no reason why you need be in university for 4 years to get an undergrad degree. In your field. There is no reason. That can be done in 2. It can be done in 2, but they're not going to change their business model. Do you think they're going to introduce AI? Not a chance. They're going to do what they can to keep AI out. That would be my bet. Long-time listener, first-time caller. Have missed a couple months of videos. 2 questions. How do we get here on gold? Well, it's been performing quite well. Gold has set the stage for quite some time. Yields on gold have been dropping for some time. For gold miners, yields per ton of ore have been dropping for some time. We just needed a situation which makes gold make sense for more than just jewelry. And with the move that the U.S. did, seizing Russia's assets in the banking system, with the discussion of a move away from the U.S. dollar, with the mounting amount of debt in Western democracies. And I think that debt is just a function of Western-style democracy, in that you're not getting elected unless you give away a lot of money. You got to buy your votes. You got to promise a lot of money to a lot of people to get elected now. I think we see the writing on the wall that the printing presses are on full blast. Crypto, there's how many different cryptos are there? But there's only one gold. There's only one gold, right? And if you look at it over the last 15 years, it's performed very well. And if you think about a 12% compounded return for the next 20 years, that puts gold somewhere around $15,000 an ounce from where it is right now. That is not an unrealistic expectation given the world that we're heading into. That is not an unrealistic expectation. I've never been a gold bug, ever, because there's never really been a reason to be a gold bug. But now there's a reason to be a bug of something other than currency, and that usually is a real asset, some type of real asset. And you want a real asset with very low transaction costs. there's a lot of tailwinds behind commodities, and especially behind precious metal commodities, and particularly those that don't really have much of an industrial application, but have more of a currency application, and that's really gold. Platinum, I think, is in there. Silver doesn't have the production problem that gold has, so I don't know that I would be too much on that. Now, here's the beautiful thing about using a laptop. The power just went out here, and I'm still on. I haven't lost anything. If this were my laptop, my desktop, I would have lost it all. I think I just found a solution to the power going out. I was going to get a battery backup for both this place here in Costa Rica and my Font Hill house, because power goes off all the time, and I'll be an hour into something. It's like, oh, come on. But look at this. The laptop is still on. All the lights around me went off, and the laptop is still on, and I'm still in the game. What do you think of that? Look what I just discovered. I just saved myself, I think, $18,000 down here. Technology advancement being deflationary. Oh, hang on. Over the past few years, it seems an uneventful place to be. Yep, surprisingly, given the economic conditions at the time. Do you believe it's purely market sentiment? No, I think it's just we're slowly coming to figure out that we're going to need an alternative to the U.S. dollar, and in the globe right now for the currencies, there is no alternative to the U.S. dollar. You're going to have to go away from nominal assets to real assets, and that is gold. Technology advancement being deflationary. What's your point of view on how the rate cuts will impact venture capital industry? Well, it'll make it easier to invest quite easily. Where deal pace slowed over the past few years, it's because debt was super expensive. Can VC be the catalyst for kickstarting deflation? Well, tech VC, yeah, because again, tech is deflationary. That's the whole point of it. Is that its value proposition is that this is cheaper than doing it the way you're doing it now. So you can either increase your margins or decrease your costs, but tech is deflationary. Breakdown of why gold is skyrocketing compared to the last 15 years. Well, the last 15 years, it has gone up. I mean, if you took a 2010 price and a 2020 price, I think the return per year was, somewhere around almost 10%, 11% per year. And so gold has been performing, but in a very benign way. It certainly hasn't been beating the market. But it is, I think, in line or beating, or at least, I think, in the next 20 years, slightly better or in line with the market. How many sectors should one specialize in? Is there an ideal number? Not really. There isn't an ideal number. I think you should be a generalist on the sectors. On all the sectors, you should know all of the sectors and be a specialist in some sub-industries within those sectors. So it's hard to know all utilities, because you have electric utilities, water utilities, diversified utilities, you have alternatives in there. So within the utilities sector, you might say electric utilities. I'm going to really focus on electric utilities. And you might say, no, I want water utilities. I want diversified utilities. So be a generalist at the sector level. And then about 3 or 4 different sub-industries. Specialize in 3 or 4 different sub-industries. Or know one sub-industry or 2 sub-industries really well within each sector. I think that makes a lot of sense. For a beginner, how many sectors should one pick while starting out? Well, always one. Start with one and get to know it. Move to another, get to know it. If you have the sector studies, there's a video for each sector. You should become a very good generalist in all the sectors. There's not now a generalist is all you need to be for the sectors. You need to know less and less the higher you go. Okay, so let's say that you're looking at SPY. Well, that is beta. You don't really have to know much to be an SPY. All you have to know is over the long term, it goes up. Oh, it does all sorts of things in between there, but in the long term, it goes up. You don't have to know very much. However, is ABC going up? That's a stock. That requires a lot more knowledge. If you go down to the sector level, well, then you have to say, based on where we are in the interest rate cycle, in the credit cycle, I know that the certain sectors will do better than other sectors. And then from the sector, you have the industry level. Well, you need to know even more information at the industry level. Then you have the sub-industry level. Then you have the company. So if you're looking at a company, you better understand the sub-industry and the industry and the sector and have a good understanding of where we are in terms of where beta is. The deeper you go, the more knowledge you need. SPY, you don't need much. Sectors, it's some generalist understanding of each of the sectors. And then as you go deeper, then that's where you start to get more specialist information as you go deeper. Certain rules, or do you have certain rules before buying anything? Let's take an example, iPhone of 1,000. No, I don't have rules like that. I basically have one rule is does this have utility? Is it useful? So I'm not going to buy a $2,000 piece of glass that sits on a mantle because it looks nice. Because I'd look at it and go, well, what function does it serve other than look good? And look good for who? For people who come over so they can see what how good I have it? I mean, that's just vanity, right? So I buy stuff that is functional. That's it. And I don't think about the price of what I'm paying. If it's functional, then I want it, and I usually get the best of what I want. So if I buy an iPhone, I think I paid $2,000 Canadian for my iPhone. It's an iPhone 16 Plus Pro. I don't know. It was the top end one I got. So give me the best one of whatever it is that I'm getting, and that's it. But it's got to be useful. Right, it's got to be functional. Do I have a case for it? No. Why? I don't know. I don't find it very functional, so I didn't buy a case. I don't really have rules for that. If it's functional, most everything I own serves a function, has some functional use. I don't think I own anything or that I bought in anything in the last 5 years that just sits there and just sits there. You know what I mean? Like a knick-knack or a fancy lamp. An average lamp will light the room. What do I need a fancy $3,000 lamp to light a room for, right? If, let's say I put the above question in a situation like you're just starting out your career and making $12,000 a year. 12,000 or 120,000? That says 12,000. I hope that meant 120. Will it change anything? Yeah, it would. If I were younger, I know the motivation is to live your life when you're younger, but I knowing what I know now, I would tell my younger self the 7-10 rule. And money in SPY over the long term will grow at 10%, which means your money doubles every 7 years. So if you're 25 and you go buy yourself a $4 Starbucks coffee, by the time you're 32, that would have been $8. By the time you're 40, that would have been 39. By the time you're 46, that would be 32. By the time you're 53, that would be 64. By the time you're 60, that would be 128. And by the time you retire at 67, that's 256. You just paid $256 for a $4 coffee. You have borrowed $256 from your future self to buy a coffee. Now imagine that you buy 2 of those every single day. 256, 256, 256, 256, 256, 256, 250. You see where I'm going with that? I would probably, if I were your age, I'd say, look, I'm not gonna live like a miser. I'm gonna have fun. I'm gonna go out. I'm gonna date women. I'm gonna take them on dates. I'm gonna go to the club. I'm gonna do this, but I'm not gonna do some stupid stuff, right? I'm not gonna buy stuff just so other people can see me with it, because I would think, what would I rather have at 45? The memory of a $300 pair of shoes I owned for 4 years in my 20s? I will have forgotten that. I've forgotten every pair of shoes I've ever owned, and I've spent a lot of money on shoes. But I remember every experience I've had. And what would I rather have at 45? More money? More wealth? Or memories of shoes and jeans and t-shirts that I used to have, right? What's that song there? Now you're just some T-shirt I used to know, or something like that. Yeah. How is an inverted yield curve a sign of a potential recession? How does it impact the economy? Well, it just changes the incentive to lend from banks, and it changes the incentive to invest, basically. So it's meant to slow down borrowing, which is meant to slow down aggregate demand. And if you slow it down enough, you actually hit stall speed on the economy. Would it be possible if you change the upload day of Costco videos to Friday? That's going to make it difficult, because recording them is tedious. It's slow because you have to record all the moves you do in Excel, so it can be tedious and slow. Trying to get it done for Friday. With the weekend, I have no distractions. I have all weekend long to do it, but during the week, there's so many distractions that I can't promise a Friday, so I'm going to leave it to Monday. But what I would say is they land on Monday, wait till Friday to watch them. You have the whole weekend. They're not time sensitive, right? Just delay watching them till Friday, and it'll be like they were released on. Just pretend I'm releasing them on Friday. Flagging a typo on your slide, curvature. Yeah, I know. You know what? That's been like that for over 2 years. And I just know when you said it, I looked at it, I go, oh, look at that. It's been there for 2 years, but I've never used the curvature until recently. So what's my prize? Pride. That's a big prize right there, pride. New viewer to your channel. Market outlooks got me hooked and interested in economics, finance. I learned so much about the markets from the outlook videos, Q&As. But with every new video, it seems like there's new exchange commodity rate that I haven't heard of before. No kidding. That was my that's your whole career in finance. When if you're mid-20s and you're in the market, I guarantee you every month there'll be something new that happens where you go, well, I didn't know I was supposed to know about that. And then things will be fine, then you'll lose money and you'll look around and go, well, what is it this time? It's this little thing over here coming out of France. And you go, well, I didn't know I needed to know about that. There are still things that show up. Oh, the spread between, this and that widens. Like, between what? Between what and what? Who's watching that? Nobody told me about that. Where'd this spread come from? I've never heard of this before, but apparently now it matters, right? So that never ends. That never ends. I wish it did, but it doesn't. Any prerequisite subjects I should familiarize myself? No. Just keep playing the game. Just keep moving forward, and this is how you learn it. There's no one place where you'll learn everything. The market is a just-in-time education mechanism. You will learn it in the time that you need it, and you will learn it, and you'll say, I wish I would have known this beforehand, but there's no way to tell it all to you. And there are some things that I don't even know are important and may never be important, but may be important. Who the hell knows? That's the beautiful thing about waking up every day. It's like, what is it? What is it today? What would be few cost-efficient strategies to reduce the delta for long position after incurred losses due to downgrade forecast of one investment analyst, while consensus of more than 30 analysts still a buy? Patience, wait. Reducing delta would be selling calls to the upside, or just selling a few shares to reduce your delta, or you just wait. That always happens. The stock will be going up, and an analyst, will issue a downgrade, and it does this for a while, and then it continues on. It's only one analyst's opinion, right? But if many analysts are downgrading the stock, then especially after bad earnings, then you should get out. 5 questions here. You once said you don't know at what price market will end today. Nope. But can we say, like, the market will be up or down based on the type of news? Like, if good news, then up, and if bad news, then down? Well, what's good news? Let's say that you get bad economic data out tomorrow. Is that good news or bad news? Right? Well, it's bad news. It's bad economic data. No, it's good news, because that means the Fed will cut rates faster. You can say it's good. You can say it's bad. We have a complex system, so there is no right or wrong, there are only trade-offs. Every piece of news that comes out has to be interpreted. Maybe it's bad news for the first 3 hours, and then nobody cares anymore, and it turns into good news, and by the end of the day, people can't get into this market fast enough. Or, it's great news all day long till 3:45, then suddenly everyone says, get me out, and the market drops 100 points in the last 15 minutes. I've seen that lots of times. You don't know. You don't know. Nobody knows. Do you work all day? I do. Like stare at the screen for 9-10 hours? No, I don't stare at the screen. How much time, according to someone, should you put in as a beginner? Staring at the screen? No time. Staring at 10Ks? Staring at educational videos? Staring at, on YouTube, different podcasts from well-respected figures, hear their opinion? Listening to Bloomberg for the Open, an hour or two in the morning for the Open? While you're planning your day, drinking your coffee, looking through your email. Yeah, I do that, but just to sit and stare at the screen for 9 or 10 hours, what a waste of time. The market will be what the market will be. You're staring at the screen will not change anything other than your emotions, but it will not change what happens on the screen. It will not change. And if your strategy requires you to stare at the screen all day long, get a new strategy. You said in live stream, invest in growth stocks in your 20s. Yeah, and forget about it. Yep. So do you think in 20s one should just invest in growth stocks and not trade in stocks? Correct. Options or anything else? Yeah, I think so. For the average person, yes. Absolutely. For 95% of you out there, that's exactly what you should do. And build a career. If you're going to be in finance, build a career in finance, right? But your portfolio, your $5,000 portfolio is not worth your time to manage. If you know how to play certain options, then that's great, but they don't require being stared at all day long, right? Will there be any course in the future how to make equity research reports? Why do you want to make an equity research report? I'm doing financial modeling now with Costco, and this is modeling from the analyst all the way to the modeler, not just the modeler, but the analyst all the way to the modeler. But why would you want to write a research report unless you're going to be an institutional equity analyst, in which case there'll be a template of which, most of the models are templated, most of the research reports are templated, and then you just write your own report in there. You'll get plenty of training for that. But no. Do you read equity research reports? When I get them, sometimes I do. If I'm interested in how a certain conclusion was arrived at, I do. Some of them are 40, 50 pages long. I'm certainly not going to read 40, 50 pages of it, but what is the important thing, I think, is what is the base case and what assumptions do you have in your base case, and can I agree with it? Not a lot though. Different reports of big banks like Goldman gives, don't you think they manipulate the reports or can manipulate it? No. There is no, I wouldn't look for, stories of manipulation out there. I wouldn't look for that. How a long position in puts can be negative. How a long position in puts can be negative 1.5% on a negative 0.3% move in the underlying. Vol was slightly up that day. I don't know enough about that one to answer. If you're talking about Wednesday, yeah, 50 basis point drop in rates. That is, well, that probably would have already been in the interbank rates. I don't know. I'd have to see an example of it, but just as a hey, here's a couple of numbers I'm going to throw at you. How's that possible? I would say, first of all, you're asking me to trust that those numbers are right. That's a big trust. I have 1 month. I have to FYI, it's on TLT, and every put options contract that day was negative, even for those closer to the money. When TLT was up by 0.3, I was down 15%. When TLT was up, you have long puts, you were down 15%, as you should be. And now I lost on a similar move down. Oh, I see. Okay, I think I answered this on the live. The implied vol on TLT dropped. Didn't go up, it dropped. So that's the issue there, is IV dropped on TLT by a lot. Underlying mechanism that drives real yields. Well, a real yield is a mathematical outcome of the nominal yield, which is market driven, and the inflation component of the nominal yield. That will be the real yield. Is the demand for tips? No. No. Higher inflation expectations? Given flat nominal yields with higher inflation expectations, it would drive real yields downwards. Pushing up prices, no. The market sets rates on nominal yields, and then there is some inflation expectation. Take the nominal yield minus the inflation expectation, that is the real yield. Is there a free website that aggregate all the OAS? Koifin. You mentioned in previous Q&A that you have enough plans for the applied level to last you a decade. Yeah. I was wondering, what are some of the first things you're interested in after you complete financial modeling? More sub-industries. More sub-industries would be the next thing. Probably through January, February next year. Maybe if I can get 2 or 3 more sub-industries up. They take a long time, 3 weeks to a month to get done, but more sub-industries. The financial modeling is, when you look at your video views, right, there is portfolio construction, there is applied options, and there is sector studies. If you look at views, it's like this. And in sector studies, if you look at all of the modules, all of the different industries and sub-industries, you get the financial modeling, it's like this. So you have to go where the money is, where the views are, that's where the money is, right? Financial modeling is by far in the short time that it's been up, the most watched so far. Currently employed full-time, and through the guidance of yourself, I am almost at the point where I can replace my full-time income trading part-time. Well, that's good. Canada, question is regarding going full-time investor trader, similar in some ways to yourself. How does the income and taxes work in Canada when someone's running their own money full-time? Doesn't change. It doesn't change. Do I pay taxes I would as an employee based on my tax bracket, or do I need to set up a company? Don't set up a company. Don't set up the company. Do not. Keep your money in your own name. Don't set up a company. It will end up costing you a little bit more in the long run by setting up a company, because you get a lower tax rate, so you can carry the gains in your portfolio, and because of that, you get about a 2 or 3% punishment rate when you try to take it out above what you would if you left it in your own name. So no, don't do it through a company. And it's just, at the end of the year, your broker gives you tax receipts, you submit your tax receipts, and that's it. That's all it is. That's it. I often see IBKR newsfeed, NYSE order imbalance. Do you know what this means? Yeah, there's an opening auction and a closing auction. So what happens is you're coming up around to 9:30, and there are buy orders coming in and there are sell orders coming in, and the market maker has to find a price where those equal each other. So if you have 100,000 shares to buy and only 50,000 shares to sell at, let's say, 50.25, the market maker has to walk that price up to, let's say, 50.30, and maybe this drops to 90,000, and that might drop to 60,000. You have an imbalance. You have a buy imbalance of 30,000. The market maker has to walk that up to 50.40, and it finds a price where these two are equal for 9:30, and that's what the stock opens at. Same thing at 4 o'clock. 4 o'clock, there is a closing auction. You have to find a price that you can clear at. Sometimes it's hard to do because you have these imbalances, right? So usually at 9:25, you'll get the imbalances. Order imbalance on this, order imbalance, buy or sell imbalance, and at 5 to 4, you'll get the same thing. You'll get those imbalances coming in because the book is not balanced going into the close. In your opinion, why is deflation so bad? Well, inflation is basically it's prices, right? And prices are companies' revenue. So if you have deflation, prices are going down, companies' revenues are going down, which means they got to lay off people. They got to lay off people. There's less demand. There's more downward pressure on prices. Revenues go down. You got to lay off more people. The people who are left in the market say, well, if prices are going down, I'm going to wait. And then revenues go down even more. You got to lay off more people, which pushes price down even more. When more people wait for prices to get lower and lower, it's just a spiral, right? It's just a spiral. If you see housing prices falling 1% a month and you're in the market for a house and there's a lot of supply, you say, well, I'll just wait. Which forces prices to go even lower. And you say, well, I'll just wait. And everyone keeps waiting because prices are dropping. So they keep waiting and they drop more, and people keep waiting and they drop more. Well, when housing prices drop, that's somebody else's equity that is being lost, right? So then they start pulling back in other places as well. What is meant by duration? Same thing that is meant by beta. Beta is a sensitivity to the market. All right, duration is a sensitivity to interest rate changes. It is a duration, so let's say something has a duration of 16. That means it will increase by 16% if the yield on whatever it is drops by 100 basis points. Right, so if you take a 30-year bond at 4.1%, a 30-year might have a duration of about 16. And if the yield falls to 3.1%, this bond should increase in price by 16%. That's a sensitivity, that is duration. How do you view the upcoming maturity wall in 2025 with U.S. Treasuries? What would it matter? People have to be, there is a marketplace for Treasuries, and there are plenty of bond funds out there that hold Treasuries. So if a whole bunch are maturing and they're getting their money, they have to then go back into more Treasuries. So who cares? The maturity is met with new issuance. So new issuance comes up and it pays the maturity, and it's not as if once bonds mature, bond funds say, okay, well, great, we're out. They got to go back in. And if more money is coming into bond funds over time, which is usually what happens, is assets under management tend to increase over time, then you need more bonds. So, there are currently about $6 trillion in T-bills outstanding as of August 31st. T-bills will turn over really easy. Presumably all of that would need to be redeemed in 2025. No big deal. Is there a risk of big crowding out moment if reserves are declining in 2025 due to balance sheet? No, the Fed will step in and buy everything that's needed. Nope. There'll be no issue in liquidity. There'll be no issue in that market. As soon as there's any sign of trouble, the Fed will step in and be the backstop. And I'm sure in back room somewhere, they know that they're going to have to do that at some point in the next few years, that they're going to have to increase their balance sheet. That the decreasing is hopeful, wishful thinking. They will increase. In 10 years, that balance sheet will be double what it is now. Any opinions on EVs? Well, that's a big question. Do you think market today generally is overestimating or underestimating growth potential and time frame of EV market? I think they were too euphoric on a single solution without thinking it through. Without thinking through the mining implications of all of the metals you need to get that done. without thinking through the sheer inflationary impact if everybody tried to get everything into EV by 2030 or 2035, by the sheer willingness, the idea that everyone would be willing to buy an EV, that there was only one solution and it was going to be EV. I think that was foolhardy. I think in 10 years you will have a portfolio of solutions with internal combustion being the primary, still by far the primary engine. Now you may have a hybrid battery engine, and maybe a 10 kilowatt battery, but certainly not a 60 kilowatt battery, and that battery might be a 40, 50 mile range battery. And as technology gets better and better, it might become a 100-mile range battery. But at no point do I think you need to get rid of the internal combustion engine. And if you don't get rid of the internal combustion engine, you save billions and billions and billions of dollars. And you save billions of tons of CO2 being pumped in the air to mine all the minerals you need for all the batteries. And you start to work your ways towards a better, greener future by just putting a small battery in front of the internal combustion engine. I think it was stupid to bet everything on a single solution like EV. So I think that's how it's going to end out. Will there be live streams from Costa Rica today? Yeah, I did the live stream Sunday. What do you mean duration when you said, okay, I already explained duration. Yeah. What securities would constitute duration? Anything with interest rate sensitivity. What do you think of large banks? I haven't followed the U.S. banks very much. Seem fairly priced given historical pricing ratio, so not sure. Yeah, probably. Well, Buffett's been getting out of Bank of America. So, what does he see, right? Obviously, with rate cuts and upward sloping yield curve, they would benefit and likely churn higher into next year. Well, you see, I don't know. Risk, I think, is that if a recession hits, historically, U.S. banks have a proclivity to hide skeletons in their closet. Reason I'm not a big fan of U.S. banking system versus Canadian banking system is there's too many banks in the U.S. There's just too many banks, too much competition. There's only 5, 6 significant banks in Canada. They pretty much have to hold their mortgages. They pretty much have to hold on to things. So I think they have higher credit standards. That doesn't mean they don't get in trouble, but they've just over 100 years, over 150 years, have a history of being better banks in terms of protecting investors and investor returns than U.S. banks as a group. So I don't know too much about the U.S. banks. Ease of access to markets for retail investors has created a more or less efficient market. I'm going to have to say less efficient. There are arguments for both sides. Wanted to hear your take. I'm going to have to say less efficient. I'm going to have to say less efficient. Most of the retail investors that come in are sheep that move in herds. So yeah, I would say less efficient. What did you do with your Tesla short? Nothing. Nothing at all. Still have it. If the federal fund projections were lower for 2024, 2026 compared to the June projections, then why did TLT go down in price? Fed funds is the short end of the curve. Fed funds is way over here. It's the overnight rate. TLT is the long end of the curve. They are miles apart. They have different drivers altogether. They are miles apart from each other. They're not the same thing. Right? It's like saying, listen, Kraft had good earnings. Why did GM go down? Because they're not the same thing. Yes, consumers both buy what each company has, but they're not the same thing. These are not the same thing. Should we go back to the gold standard? No. CFA level 1. Okay, I already answered this one. Utilities will be growing, expanding sector for some time. I agree. What investors, traders, or persons in financial world you respect their thinking? Howard Marks, probably number one. Howard Marks. Do you consume any books or podcasts? I like Howard Marks. I like that one. How do you remember all the information you read? If it's relevant, you remember it. If you can attach it to something or some question you had or some lesson or some company or some real life thing, you remember it. How to improve my memory? I cannot retain things, what I've read 2 days back. It's probably because what you're reading doesn't answer any questions you have. If I read a book on a topic of which I had no questions once it was over, a week later I'd say, I've forgotten most of what I read because none of it was relevant to me. So, yeah, it's, read on things that you have a burning desire to know. How to improve focus and concentration? I can't answer that because I don't have a problem with it. Do you think our generation have problems with memory and focus because of mobile phones and social media? Well, I think it might play a role, yeah. Problem I'm facing with focus, concentration, memory. Well, do you think maybe you're just not that interested in what you're doing, right? If you were interested, you'd be focused. You would be focused. Do you have trouble? Do you like sports? Do you like football? Do you have trouble watching a game and a couple hours later you forget who wins or who scored or what the players are on the team? Do you go, oh, I can't even remember any of the names anymore? Do you remember them all? Probably because you're interested. If you're forgetting a lot of stuff and you can't remember and you have no attention and you can't stay focused or concentrate, maybe you just don't like what you're doing. Maybe it's boring for you. Maybe that's the true problem, is at the end of the day you probably say, I'm really not that interested in this stuff. And that would be one reason there. At 2 p.m., just after seeing 50 basis point cut, I closed my short-dated TLT long put and short call, fearing possible run-up by TLT. Sold out of the money put and bought out of the money call. Could you please critique my moves? Well, you didn't understand what you were doing. You got a move on the overnight rate, and you decided to change your position on the long end of the curve. What you should have looked at is not the move that they made, but the path of the short rate going forward for determining, how shallow the short rate would go and what effect that would have on the long end of the curve. Also, it had an incredible run-up before the rate cut anyways, right? So you allowed the market to change your mind, to whip you around. Or maybe you were in a trade that you didn't fully understand to begin with, so you didn't understand when to hold and when to get out, which is a signal that maybe you want to stick with just things you can understand as opposed to something like this. Yeah. I mean, criticize the moves. I would say it's you let the market push you around. Should I have waited to see the market reaction? Most definitely. Nothing matters on Fed Day until Powell has the press conference. Everything happens in the press conference. Feeling like I behave like a typical retail investor. That's how they behave. They do. Is they make decisions, on the spot. They react to the move in prices as opposed to sticking with their thesis. And you have to understand, why am I in this trade? Why do I think this is going to happen? Why do I believe this? What's the worst thing that can happen, and can I live with it? Right? I sold calls on TLT, but I'm long TLT. Worst thing that could happen is it gets called away from me at a higher price and I get to keep the premium. Okay, that's not bad. Best thing is, well, TLT doesn't really move anywhere and I get to keep all that premium. Heads I win, tails I win. Beautiful trade setup. Excellent. Increasing deficits, benefits, utilities. I can't draw a line from that, but okay. Gold remains well supported going in 2025. I believe so. Hope they didn't take any more doorknobs. Yeah, no kidding. Just watched a video titled, "Why Do Canadians Go Ballistic in War?" And I had no idea Canadians were historically so brutal during war. Oh, I didn't know that either. I'll have to watch that. GM could be considered a value trap because of their fixed costs and high debt. Well, I mean, it's any automaker has fixed costs and debt. Keep in mind when you got to understand what you're looking at, right? And you have to attribute the parts. Companies report earnings on a consolidated basis. Consolidated. You have GM and you have GMAC. GMAC, right? GM is the car company. GMAC is the financing company. So GMAC offers financing to customers with GM, and GM reports the whole thing, which means when you look at the debt, you're looking at GM debt and you're looking at GMAC. So take the GMAC debt and look at the receivables and the lease assets related to the debt. So you have all the money that's owed and all the money that's been used. So GMAC will issue bonds and will use those bonds to finance the vehicles that GM then calls revenue, and it waits and it gets paid back every single month. So if you take the debt and you remove GMAC, which is a profitable company on its own, GM's debt is not that big. It is not that big at all. So it's because it's consolidated, you have a financial in with a non-financial, and all financials have a lot of debt. Look at banks, they have a lot of debt. You wouldn't run away from them just because they have debt. It's the nature of their business model that they finance their assets with debt. Same with GMAC, finances its assets with debt, but you wouldn't run away from it. So you need to tear it apart. So, this is where you can make superficial statements like that, and you might miss what would otherwise be a good operating company. Let's see. I've read this. This is just a comment. Academic master. There we go. We got another one behind us. In the middle of a power outage. Power's still out here. Looking around in a really dark room. That means my internet is down and I can't upload this, so I can at least save and render this, put it in Final Cut Pro, do all the work I have to do, and hopefully the power will be back on by then. All right, ciao.